So we discussed four conditions. You buy all-time high stock, it corrects. You buy corrected stocks, it continues to correct. You buy a company that has corrected for so long and is undervalued right now, it doesn't do well for next 3 years. And after 3 years, you exit a laggard stock, stocks become multi-bagger within a span of 1 year or so. Now, these are the only four conditions where people lose money / do not make money. Most of the investors fall in this category. I'm telling you, you are not doing a lot of things wrong. You are doing only one thing wrong, and that is not getting the cycle right. Newbie investors think that getting a quality company is enough to make returns in the market. Buying a good potential multi-bagger will help them create big money in the market. Well, it's not enough. It's actually bare minimum. If you cannot spot quality companies, you have no business in the market. The real game is to get the cycle right. Because when you get the cycle right, you get the timing right, you get the valuations right to a certain extent of accuracy. Now, getting the timing and valuation right will actually make you help achieve great CAGRs. Now, how to get the valuations right? Some investors go for ratios like P by E, price to earning, as I explained earlier in the video. Now let me explain why price to earning becomes irrelevant in most of the cases. We have companies like Coal India, which have price to earning of 4. If you look at their 10 years return, it's in negative. If you include the dividend, maybe it's 1.5 times. And then you have companies like Hindustan Unilever, which have P by E ratio of 60. And if you look at their last 10 years returns, they are more than 4x or 5x. Dividend included 6x maybe. Let me show you an example of how price to earning works in most of the cases. Now, why does this happen? For that, we need to understand the P by E ratio. Price to earning is made of two parameters, price and earning. So if you look at the simple aspect of it, if price goes up, price to earning goes up. If price goes down, price to earning goes down. But a most important aspect that investors fail to notice, if earning goes up, price to earning goes down. And if earning goes down, price to earning goes up. In most of the market companies, earning is more volatile and swift as compared to price. So when the earnings change drastically, your price to earning becomes irrelevant. 90% of the companies, 95% of the companies are cyclical in nature. And that is why their earnings are very, very volatile. Let me give you an example. Here's the chart of price of a company, and below is the chart where you can see the price to earning of the company. Now I have marked every 2 to 3 years price to earning peaks and price to earning bottoms. You can see whenever the price to earning bottom is happening, the price is actually peaking. And whenever the price to earning chart is peaking, price is actually making a bottom. You can look at it in this case, and you can look exactly the same thing in this case. Whenever price to earning is peaking, price is making a bottom. And whenever price to earning is making a bottom, price is making a peak. So in these cases, price to earning is actually disproportional to the stock price. So when you use price to earning as a decision-making multiple, you get trapped in a lot of opportunities. I also talked about Coal India, remember? It has been undervalued when it comes to price to earning for last 10 years, but it has not given any returns if you bought it in the IPO. Now I will explain what you have to track if you want to get the cycle right. So to understand that, you have to understand what are the cycles. So basically there are 3 types of cycle in the market which predominantly affect the stock price, affect the business worth in the market. One is economic cycle, second is industry cycle, and third is psychological or sentimental cycle. Now, as a country, India's economy has been doing well for last 30-40 years. So if I have to make a chart of economic cycle, it's a sinusoidal curve but is gradually increasing. Since the cycle is long enough, you cannot see the peak and the trough in this cycle. Second comes the business cycle. Every industry goes through headwind and tailwind in some years. It happens due to supply demands, due to government regulations, due to export import, and due to management inactions also. So whenever sector are not doing well, you can see the sectors make bottom. Whenever sectors are doing well, due to fundamentals, it is making peak. And the third is sentimental cycle. You must have seen, given the same fundamentals over the year, stocks go 20-30% up, 20-30% down for no good reasons. Now that is because of the market sentimentals. Now that is called market sentimental cycle. Now if you superimpose all these 3 cycles, what you get is a stock price. So there are 3 predominantly cycle which will affect your stock price. Number 1, economic cycle. Countries' economic cycle are decadal story. Now you don't have to be macro expert to know that India's economy is doing great for last 30-40 years. The index are GDP growth, import export and debt. Mostly these cycles last for 30 to 50 years, or in some cases even more. Now we don't need to really worry about the economic cycle, so we will shift to second cycle, which is sectoral cycle. Industries and cycles go through up cycle and down cycle also. It's predominantly because of supply demand, government regulations, import exports and competition also within the players of the sectors. Let's say you are running a business, you are doing great, you have good profit margins, undoubtedly you will attract a lot of competition within the sector. More companies will try to enter your space, huge capex will come, and that will increase the supply of the products or services that you are providing, and thus the profit margin will come down. And since a lot of companies are working a lot of companies will go into survivorship mode and they'll face headwinds. And this is why as a player of this industry, you will not enjoy the premium valuation that you once did. You can refer it as a start of down cycle. Now you can assume the same thing for raw material prices also. So industry cycle, as you can see, it's very subtle and it continues for years before it changes its course. Now the third cycle is sentimental cycle. You must have seen, given the same fundamentals, companies stock prices do 20% up, 20% down in a year. Now that is because of the market sentiments and supply and demand in stock market. So when you superimpose these three cycles, you get your stock price. So let's say in case of hot stocks, let's say the company has already done well fundamentally for last 4-5 years and there's been small correction in the market due to sentimental cycle. So if you are buying a stock, you are most probably buying the stock here. And as you can see, for next 4-5 years, it will become very hard for you to even recover the money, forget about making money. If you are investing in a small cap, the price correction will be huge. It can go down to 40-50% also. And if you are investing in a large cap, the price correction will not be that much, but the time correction will exactly be as much as in case of small cap. Now let's take an example of undervalued stock. Let's say sector was not doing well for last 4-5 years. It was in the down cycle and there has been a little market correction. So most probably your buying zone will be here. So the probability of you catching the bottom will be way higher when you buy the hot stocks. And the probability of you making multi-baggers in the next 3-4 years will also be higher. So to conclude this, to get the right cycle, number one, you have to keep looking for the companies where the revenues and profit keep increasing. Number two, valuations have cooled down in last 4-5 years. Meanwhile, fundamentals have either done very good or they have been constant. Number three, sector is facing short-term hiccups due to government regulations, due to supply demand or due to management complacency. Number four, in past, due to management carelessness, company has lost market share and now you can see some of the corporate actions happening which can result company to do well in the market. So basically you have to find out the companies which are in the down cycle because of the sectoral down cycle or management efficiencies, and you have to find the potential winners among them. Now if you think about it, we have covered two major curious cases here. One, if you buy undervalued quality stocks, you will not be buying at the top. So first problem is solved. If you understand the cycle, you will not be buying the companies which has just corrected for 3-4 months. Instead, you will be buying the companies which have been undervalued for last 2-3-4 years, because you understand the cycles are not monthly stories, not quarterly stories. They work in years. Now let's come to third condition, where you buy a stock and it stays laggard for next 3 years, 4 years. What can help you in this regard are the triggers that you see in the market. Now those triggers can help you identify the companies which are going to do well in next 2, 3, 4 years. So you don't have to wait for 4, 5, 7 years for your stocks to run. Instead, you can identify the companies which are going to do well in next 2 to 3 years because of these triggers. Now what are those triggers? Number one, promoter holding increasing. Number two, capex. Number three, cloning. And number four, cash rich companies. I'm going to discuss all these with detail here. Number one, promoter holding increase. The companies or the multiple number of companies in the sector where promoter are increasing their stake in their own company. Now this can lead to a mega buildup and can lead to ultra multi-baggers in the years. This can also tell you that there is a tailwind that is coming in the sector. So in this case, you have to track the companies where promoter holding increase has been more than 1% in last 1 quarter. Now I'll discuss pros and cons both with you. The pros are very simple. Promoters make most amount of money in the market. This can lead to future ultra multibaggers. This also tells you the tailwind that is coming in the sector itself. This is a big indication of reversal in the sector itself. Now with opportunities come traps also. It becomes easy sometimes for the promoter to deceive the investors because they know that you are following them. Sometimes it has been seen that the wrong buying happens. Sometimes it works like an exit tool also. I will explain you how. And third, a lot of time the buying happens just before the dumping. Now I'm going to share some examples with you where the promoters have bought small quantities before dumping a big lot. As you can see in this screenshot, from the promoter holding 57.86, the promoter holding increased to 58.13 just before promoter dumped 3% in September quarter and then dumped 3% more in June 2021. So as you can see, the triggers work very good, but you have to understand the opportunities and the traps within that trigger. Now the second trigger, as I talked about, is cloning. Just like promoter holding increase, when the ace investors buy in some companies, that can also turn multi-bagger or even ultra multi-bagger in next years. Now as the name suggests, you are cloning the ace investors that have worked very hard in the market and made a lot of money in historically. Ace investors are pros who have done well in the market. The stocks they have been buying can lead to 10x and 20x in the future also. It gives you confidence on the quality and the corporate governance part of the companies. But the con of this strategy is it's very hard to track promoters because you get only the quarterly updates, and before you get update, if the stock corrects 20-30%, it's a capital loss for you. Same as the promoter case, sometimes buying is done just before the big exit and it becomes the big exit tool. So in my span of 10 years in investing, I have tracked a lot of ace investors, and in some cases I saw this pattern which I'm going to share it with you. Example, a promoter buys the company, the news comes. Now this is the day of the news. For 4 or 5 days stock does well. After it starts consolidating, then it consolidates further for next 1 or 2 months. After 2 months you realize that the ace investor never bought in that company when the report of stock holding, shareholding comes. So this has happened a lot of times in case of some particular ace investors also. So if you are tracking a ace investor, you have to look at the history of ace investors, the stocks that they bought, the duration that they bought for, and if you are an investor, you should always look for the ace investors who believe in holding the companies for long term, for 4, 5, 7 years, not for 2, 3, 4 months, because their intentions can be different about the stock, and you, while as a long-term investors, you will get trapped in the company and there will be no option but to get loss and to have a capital loss on that stock. Now the third trigger that I was talking about is capex. When companies increase their capacities to counter the demand that has been produced by the growth of the industry or by the growth of the country, the capex growth can give boost to sales growth, and that is why it is a good trigger. Be a part of your strategy. As you can see, I have shared the screener query on the screen. So the opportunity in the capex is it can lead to great multi-baggers in the future. Capex growth leads to sales growth, and that eventually leads to profit growth and stock price growth. And it's also a big indication of the mega buildup in the sector, which can lead to ultra multi-baggers in next 5, 7, 10 years. But there are cons also. Mostly capex happens at the peak of the cycle. A lot of times capex increases the competition that affects the profit margin, which affects the stock price in short to mid term. So capex can actually lead to correction in the industry also. So you should look out for the companies which are already overvalued and doing capex. The fourth trigger I'm going to share with you is cash rich. It's a great value arbitrage when the company has more cash than the market cap of the company. It can be a quick multi-bagger when the market realizes the worth of the company. I've given the screener query for the same also on the screen. So the opportunity is it's a great value arbitrage. It can lead to multi-baggers. It can even lead to 20x, 30x if the cash is deployed in the company's growth. The cons are very few genuine opportunities are available in the small and mid cap. Mostly opportunities are available in the micro caps and the penny caps only. Some of these opportunities are available in the low growth companies also, where multi-baggers rarely happen. So by using these 4 triggers, you can solve your third and fourth problem of company being laggard for 3-4 years and not giving any returns, or you exiting the company and stock becoming multi-bagger in just 1 or 2 years. So if you use these triggers, you are not only going to solve this problem, but you are going to ride the next multi-bagger cycle, next trendy cycle before even the trend comes.